Good day, friends. We have an interesting IPO opening on Wednesday, the 2nd of December, from Burger King India Limited. Burger King is the second international MNC branded burger and other related items, fast food, QSR company to be listing on the exchange. We currently have McDonald's, which is in the listed space, and also Domino's, which is in the listed space, owned as a franchisee by Jubilant Foodworks Limited. The first one to come into India and list on the markets was Jubilant Foods way back in 2000 and, if I'm not mistaken, 2008, 9 or thereabouts. And we had Westlife Development, which is the franchisee for McDonald in South and West India, which is the other listed entity. Coming to the IPO, the company is looking to raise 810 crores through a combination of a fresh issue of 360 crores and 450 crores by way of a fresh issue in a price band of 59 to 60. Since the RHP has been filed, they have issued a corrigendum and mentioned that they have sold 2.7 crore shares further at the rate of 60 rupees to 3 investors, SBI Mutual Fund, Amansa International, and one other company. What is interesting is that the promoter would be diluting his stake significantly with this fresh issue of 2.7 crores, which is roughly 9% of the pre-IPO, and would be a little lower considering the fresh issue of 450 crores. Effectively, post-listing, the promoter shareholding would come down below 60%. This raises a number of questions. One, it does show that there seems to be tremendous demand. That is why the promoter chose to sell 2.7 crore shares over and above the IPO. This also indicates that when this is a growing business and post-COVID, it is expected that such fast food chains would do well. What was the need to sell 2.7 crore shares at 60 rupees? Does it mean that the promoter is not too sure about his business? These are questions which are quite logical when raised, but of course there are no answers. Let's come to the performance of the company so far. The 6 months results which have been declared by the company for the period ended September 20 were as good as a washout. Nothing significant happened simply because of the fact that fast food outlets, which are mainly located in malls, multiplexes, food courts, etc., were by and large shut during the COVID lockdown. They are now reopening, and the company has about 95-96% of their stores reopened. Of course, it's not business at 100% as yet, but hopefully in the next couple of weeks going forward, it should be back to normal. The company has about 268 outlets compared to a significantly higher number by Westlife, which is about 360-70. One needs to consider that they are much larger in number than this company, than Burger King, simply because of the fact that they have outlets in just South and West India, while the franchise for North and East was earlier with another company and now has been taken over by McDonald. The revenues of Westlife are about 1,500 crores plus, while the revenues of Domino's, that is Jubilant Foodworks, are about 4,000 crores. The revenues of Burger King were about 840 odd crores. All these numbers are for the period ended March 2020. While Domino's is a profit-making company, Burger King as well as Westlife are yet to make profits as of date. Coming to where we stand, the issue looks attractive, and the fact that at 60 rupees it would be oversubscribed is without a doubt. What is interesting is the track record of the promoter. He has brought two issues earlier. One was that is S. Chand, and the second was Indostar Finance. Both these companies have not done well at the bourses, while S. Chand is trading at 10% of its issue price of 670. Indostar is trading at a shade over 50% of its issue price. This, mind you, is after the fact that a larger portion of the company was sold to Blackstone. So track record, not too impressive. Business-wise, we as Indians love to go out and dine, so you should expect the company to do well. How would this company fare post-listing? Let's understand the HNI category is somebody who is very, very important for post-issue or post-issue listing performance. In the last few issues, HNIs have not been on the right side of the listing saga. For example, Gland Pharma, we are all aware that the issue did not get adequate response from either the HNI or the retail and remained undersubscribed in both the categories. The issue trades at a 50%, 40 to 50% premium since the issue listed. Prior to this, you had a couple of issues, Angel Broking, UTI AMC, which did not open with gains when they were listed. You had the issue from Mazdam Docs, which was oversubscribed 678 times by HNI, making the cost of funding equal to the issue price of 145. There was no way that the share could sustain a funding cost of 145 and list at 290. The HNI investor, leveraged HNI investor, lost money there. In CAMS, the issue price was 1230. The cost of funding made it a little more expensive than the listing price, while the share trades at a premium to the issue price. It wasn't enough for the HNI to make money. So all in all, the feeling of left out, having missed the bus, not having got his fair share of profits is there. There could be subscription in this issue with a vengeance, therefore. Historically, it has been seen at the market that when the funding cost exceeds 60 to 70% of the issue price, the listing becomes a little risky. And more often than not, it has been seen that the price is unable to sustain the cost of funding. There are even number of exceptions to this rule, but by and large, this is what happens. So what we need to see is how much this issue gets subscribed. Grey market premiums indicate that the issue subscription by the HNI category is currently being discounted between 325 and 350 times. If this exceeds and becomes, say, 400, the expected listing price for break-even would have to be almost 100 rupees. Whether that will sustain in market is the key question. Thank you.